I'm Owen Bigland. This is the Inside Edge video blog. Happy Saturday. Going to be a fairly quick one today, I think. I hope. I got to be out of here in about 10 minutes. It's Saturday. I got houses to sell. But I wanted to do a kind of a regular Saturday blog here on just kind of general investing and the mindset and the keys to becoming achieving financial success with your retirement funds, your RSP and your TFSA. So this is a guy I follow. I've mentioned him before, Dividend Growth Investor. He's on Twitter. He has a blog, The Dividend Growth Investor. I've been following this guy probably for 10 years. He's great. I mean, his strategy is buying companies, high quality companies like Johnson & Johnson and Procter & Gamble and Pepsi and Visa and Home Depot, Canadian banks, companies that have a long track record of paying a nice dividend. Doesn't have to be a huge high dividend, but they have a history of increasing that dividend every year like clockwork. So a Visa, for instance, the yield on Visa right now might only be about 1.2%, not a huge yield, 1%, but they have a history of increasing that dividend double digits, 10-15% every single year going forward. Eventually that your yield on cost starts to get pretty big. His goal, of course, is to build, similar to mine, build a big enough portfolio that eventually you can just live off the quarterly dividends that your portfolio pays. And those dividends keep increasing every year as well, much higher than the current rate of inflation. You know, my average dividend growth rate, this is the dividend growth rate on my portfolio, probably runs between 8 and 11%. That's the average dividend increase I'm getting. So much better than inflation. So you'll keep it's indexed to inflation and then some. So that's his plan. Mine is a hybrid of that. I have a dividend growth strategy. I've got, Canadian banks and Bell Canada and a lot of the same holdings he has, but I've overlaid that with a large percentage of just index investing. ETFs like the S&P 500, the Triple Q, the Vanguard Growth, the Vanguard Dividend Appreciation Fund in Canada, the XIC and the XEI. So I've told you guys, 50% of every dollar that I've been putting in, and probably more lately, has just gone to the indexes. The other 30 or 40% would go into this dividend growth strategy. So here's kind of his keys, what he's learned over 15 years. He's had this site for 15 years. And a lot of the stuff I've touched on many times, but let's just recap them here quickly because they're all really good. I think this guy is a certified accountant by trade, and then he's been investing for something close to 20 years, and he's had this blog for the last 15. So here's what he's learned. Diversification matters. Well, he, I think, owns about 100 individual stocks. That's a lot. He's essentially built his own ETF or his own index fund here. But diversification does matter, and that's why I suggest to you guys you just index invest. One stop, the S&P 500, you own 500 of the best American companies there is. VTI, which is the Vanguard total market, you'll own 3,500 companies with one purchase. So diversification matters. Some are going to pull their weight every year where they're having good years. You're always going to have some laggards and some companies that you hold that are going to have some bad years. That's what diversification does. It smooths out the ups and downs. Patience is important. Yeah, I've done tons of blogs on this. Especially if you're investing for retirement in your RSP and TFSA, buy the index and then just sit on your hands. There's nothing further for you to do. I know the financial industry, or you watch these shows, will tell you need to be doing something, but you don't. It's a lie. It's a big lie. It's been going on for years. It's been proven. These guys have been found out a long time ago. It's all for entertainment purposes only. Just buy a good quality. If you really want to buy individual names, buy high quality, collect the quarterly dividend, and just keep reinvesting. You don't need to spend a whole lot of time studying the markets or watching CNBC or Bloomberg. Stick to your strategy. Totally. You got to have a strategy. This guy's strategy is a dividend growth strategy. Mine is the same dividend growth strategy, plus I overlay it with just simple index investing. Stick with a strategy. Those are the only two, I can tell you guys, that will really work. They're both buy and hold and do nothing, sit on your hands. That book I'm going to do a review on, Winning the Loser's Game. There's all kinds of other strategies, swing trading and, buying on momentum and all this other stuff. It's all a giant joke. Guys, it's a facade. It won't work. The only two strategies that will work really is just a buy and hold strategy. Either do what this guy's doing, buying quality names and reinvesting the dividends, or I think just the best is buy the indexes through Vanguard and spend all that time you were going to do in some exotic trading formula to try and outsmart the market. Spend that time with your family, getting better at your career, starting a side hustle, or getting in shape, or getting more sleep, for God's sake. Keep investment costs low. Well, this guy's investment costs are zero, pretty much. He's with Schwab, I think, so down in the States, you get free trades. In Canada, we're not quite as lucky. You pay $9.99 for a trade, which is still great. I told you guys I used to pay $150 a trade not that long ago. The internet has been an incredible boon for individual investors like myself. ETFs. The typical ETF I hold has got a MER of management expense ratio of probably 6 to 8 basis points, so next to nothing. You do not want to be getting into managed mutual funds, or even now there's a whole new breed of these managed ETFs. I would totally stay away from those. It defeats the whole purpose. The management fees on these are upwards of 1%, 100 basis points. It's criminal. Just buy the index, buy the S&P 500, buy the Vanguard VTI, buy the VIG. These are next to nothing, and that's what you should hold. Keep your costs low. I've done blogs on, doesn't sound like much, but even 50 basis points will cause a tremendous amount of damage to your returns over 10, 15, 20 years. It's that compounding. It doesn't sound like much. 1%, 0.75% management fee. It's huge. It'll knock a third of your return off after 30 years. There's lots of videos and lots of documentation you can get online about what fees can do to your long-term returns. It's shocking. Avoid micromanaging your investments. Yeah, I don't do any micromanaging my investments. I buy high-quality names like a TD or a Royal Bank or an Apple or an Amazon and Home Depot, and I do nothing with it. I've never sold them. The only few times I've sold, as I told you guys, is like an Apple where I trimmed a few hundred shares because it went up 1,100%, and it became too much. It's still the largest holding in my portfolio, but it became completely overweight. So that's the only time you should really be selling in a good position there, where it's gone up so much that you have to trim a little bit. With ETFs, of course, you don't have to do any of that. There should be no micromanaging of the S&P 500 or the VTI or the TSX. You own the best of the best there. Just let them do their thing. Avoid noise. Yeah, I told you guys, if you really want to watch CNBC or Bloomberg, remember, it's just entertainment. Don't let them talk you into doing anything dumb. Again, you're bombarded with it these days with social media and everything else. Tune most of it out. I do. I spend very little time on any of that stuff. I have a couple of newsletters I subscribe to. I read the Wall Street Journal, but I don't let any of that stuff influence my thinking on my overall strategy, which is index investing layered over top of a dividend growth strategy. Focus on things within your control. Yeah, that's how many times I've told you guys. All these exterior things like wars and pipelines and interest rates and the economy and all that stuff, it all is transient. It comes and goes. Today's problems you won't even remember 2 years from now. There'll be another whole new set of them. Just stick with the strategy. That's all there is. Focus on what you have control over. Avoid experts and their opinions. Yeah, so again, it's the same thing. Listening to the media, listening to these talking heads on Bloomberg. I'll do more stuff on this. I've done lots before. I really like to lambaste these guys because so many of these guys have been really, outed here. They never will reveal their returns based how they stack up to the S&P 500 over the last 2, 5, 10 years because it's dismal. They've been left in the dust. Now, listen, I don't want to throw all money managers under the rug here, under the tires. I know I have people in the financial industry that watch my blog. Listen, there could be a good case for hiring a professional money manager to run your money, especially if you've got a very large portfolio. You just don't have interest in it whatsoever. You don't want to do that 100 hours like I've told you. You have to do the 100 hours, and then you can determine whether you want to do it yourself, which is very easy, especially with index investing, or you do want to put it in the hands of a professional. A professional can provide you with a lot of good things. I have a professional accountant that I consult on a pretty regular basis. As I get older and when I'm getting to get ready to start drawing down some of my portfolio, I will consult a planner, a tax consultant on this. how I sync it in with my Canada pension plan and my real estate and everything else, and with my wife. So the other thing I've talked about, if you are going to get someone to manage your money for you, I would strongly urge you do some homework and hire a fiduciary for-fee planner. So this would be a financial planner that would work very much the same as an accountant or a lawyer. He will charge you an hourly rate. It's not based on what they're selling you and the commissions they earn from the products they sell you. Because normally, a lot of these guys like to get people into high-cost managed ETFs or mutual funds, or they get you into individual stock that they like to, what's called churning. They will buy and continuously sell your portfolio. Not a recipe for good returns. So there are some fantastic money managers and financial planners out there. For some people, it can make sense. Again, if you want to use one, I would say, just spend the 100 hours to learn the basics. Then you can decide whether you want to do it yourself or hire someone. And again, hire a for-fee planner. They're not making their money off of the products they're selling you. They're going to probably put you into a very low-cost basket of ETFs through Vanguard or I-shares that you will manage yourself. And then generally how it works is maybe every year you'll sit down with them for a couple of hours and they'll review it with you, maybe make some tweaks to it. Or perhaps they might overlay that with some good individual stocks for better yield, like a Bell Canada or a TD or a Royal. But they charge you by the hour. That would be the way I would go. And final one is try to improve all the time. I've done lots of blogs on Saturday here. Always trying to keep learning. I've been an investor in the stock markets now for coming up to 30 years. I would say I've been a real dedicated investor for 20. Probably, I don't know how many thousands of hours I've spent. You know, the one thing I'll tell you guys, I'm going to get more into the more I learn and the more books I read, though, I think I'm almost at the end now of investing philosophies on how to get my money working for me. I'm pretty much done. And that is, it's come full circle. It never really got unwielding anyways. I've always just had a dividend growth strategy and then, a layered over top of an index investing strategy. I think, unless you really love it like I do and want to do your due diligence on individual stock and you're going to do a buy hold to get a little better yield, I would just index invest, buy a basket of good quality index funds, maybe some European stuff, some emerging markets, Canada, US, a dividend one, and that's all you're going to need. The numbers just don't lie. The books I've been reading here the last few years, it all circles back to most people like you and me should just index invest and call it a day, and then spend all that time looking at markets and buying and studying companies, spend that in other more productive ways. I still do it because I enjoy it, but I think going forward here, I've told you guys, it was 50 cents of every dollar. I'm probably going to be putting more like 75, 80, 90% of every dollar just into the indexes. I've already got a pretty good basket of individual dividend paying stock that's producing a nice quarterly dividend for me. Now I just want it, set it and forget it. Buying the indexes. Eventually what I'll do is just put it on the DRIP, on the dividend reinvestment program. It'll be one of those things where I could retire, take a trip for 3 or 4 months, and I would not have any worries about looking at my portfolio. It's on autopilot. And that's the way most of you guys should do it. I'm Owen Bigland. As always, thanks for watching. Have a good weekend. I'll see you next week.